You can't brag about the fact that we had one lone month where high prices didn't get any higher. It's not like they went down, they just didn't go up. But if people were struggling with high prices, their struggle didn't get any easier in the month of July. It remained the same. How many times last year did all these analysts, including people in the government, claim that we had peak inflation? I mean, I got sick and tired of hearing peak inflation back in 2021. I had to keep saying we're nowhere near the peak. And the same thing applies today. Yes, we may have hit a temporary peak. Maybe it'll take a few more months before we see a year-over-year increase that's higher than the 9.1 that we got in June. But there's no doubt in my mind that we will get a higher number than 9.1. We are nowhere near done with this inflation problem. It is going to be here for years and years and years, probably the remainder of this decade, and probably then some. And, so just looking at one-off month where, we didn't get a big rise and having this premature victory dance, I think is an insult to the American public. Look at the recessions of the 1970s. You had rising prices there, during stagflation, and that's what my forecast is. Now, the reason that I believe that inflation is going to kick into a higher gear as this recession that we are in gets worse is because I believe Powell is going to pivot ultimately, and he is going to give up his fight against inflation in order to fight a different foe, and that is going to be a recession and rising unemployment and potentially a financial crisis, either one that has already happened or one that is rapidly approaching. And so I think Powell is going to choose what he believes to be the lesser of the two evils, and I think he's going to pick fighting recession and propping up financial markets and monetizing government debt so the Treasury doesn't have to default. I think the Fed is going to pick that over inflation. And so unlike the pivot that we got with Volcker back in 1982, where Volcker pivoted after a victory in his fight against inflation, Powell is going to pivot despite defeat. Inflation is going to win. And so when we go back to 0% interest rates or whatever we do, and when we go to QE5, which is going to be launched, I don't think the Fed is going to shrink its balance sheet very much. It's going to shrink it less than it did last time it tried to do it, which is an impossible task given the bubble that it's inflated. I think when the Fed goes back to stimulus and creating inflation, when inflation is maybe double or triple or quadruple that 2% target, the markets are going to react very differently than how they reacted in the past. Because in the past, the Fed was able to justify all this cheap money because they said we don't have enough inflation. We're still below target. Well, when they go back to this stimulus, when inflation is triple or more their target, the markets aren't going to buy it. And so I think all the inflation that they are going to have to create in order to stimulate the economy out of this recession is going to ignite a powder keg. We already have an inflation problem, and Powell's going to pour all this gasoline on it. And so we're going to see inflation moving up to a much higher level, even though it's already very high. In fact, it's probably double what the government claims in the CPI. If you want to know what's actually happening to prices, you've got to double what the government tells you, and that's more accurate. This recession that's here is going to get worse, and that's going to force politicians to try to do something. Once the political pressure is greater because of unemployment and the economy, then the Fed is going to switch its attention from inflation. But the inflation problem is not going to go away. It's just that this other problem is going to loom larger in the eyes of the Fed. And I think what's driving the markets is this bad news on the economy is good news for the markets, because it means the Fed will pivot sooner. And before it pivots, it will raise rates less than it might have raised, absent the bad economic news. And again, you still have all of these Keynesians out there that think bad economic news is good news on inflation. They think the weak economy will weaken inflation. It won't. It is going to strengthen inflation, especially when the Federal Reserve and the government respond to the weakening economy with more stimulus, because that stimulus is inflation. So they're going to start creating more inflation, even though we already have too much inflation. And so the problem's going to get much bigger than the markets understand. I still think this is an overall bear market. I think that rate hikes are going to continue to take their toll, but so will inflation. I think inflation is going to harm a lot of companies that have a problem dealing with it. I think a lot of demand is going to be destroyed for a lot of discretionary items because people are going to spend all their money on food, on energy, on insurance, on rent. I think last year we set a record for IPOs of companies that lose money. And so all of these companies, zombie companies, are creatures of the bubble that was inflated by the Fed with inflation, artificially low interest rates, zero interest rates, and quantitative easing. That's what gave birth to all of these zombie companies. And now that the Fed is raising rates and is no longer doing quantitative easing, all these zombie companies are going to die. Well, I think the nature of this financial crisis is going to be a lot different than the one we had in 2008, because I don't think the Fed is going to allow it. That's one of the reasons I believe that Powell is going to pivot, because if the Fed does keep raising rates, we will have a financial crisis that looks like 2008, only much worse. Because 2008 was about bad debt. It was about people borrowed money and they couldn't pay it back. And the collateral for the loans was no good because it was real estate and prices went down. Well, we have much more debt now than we had in 2008. I mean, by an order of magnitude. Everybody has more debt than they had back then. And so this is going to be a much bigger crisis when the defaults start. And all those banks that were too big to fail, that were bailed out in 2008, they're a lot bigger now. And when they fail, it's going to be a lot worse, except with inflation too high and the Fed fighting inflation, there are no bailouts. There's no TARP 2.0. All these banks are going to have to be allowed to fail. And that means customers are going to lose money, not just stockholders or bondholders. The customers are going to lose money because the FDIC doesn't have any money unless it gets it from the Fed. And the Fed isn't going to be giving out money if it's fighting inflation. It's taking away money. So I believe the Fed is going to pivot to prevent that massive financial crisis. And so what we're going to get is a sovereign debt crisis and a US dollar crisis. So it's going to take the form of a crashing dollar. And so the people who are going to lose money are not the people that are just holding subprime mortgages, but the people who are holding US Treasury bonds or any bonds denominated in US dollars, or even people that have US dollars stuffed under their mattress. You know, the dollar has risen so far in the early stages of this big inflation because investors are still delusional about the Fed's ability to contain inflation and bring it back down to 2%. When they wake up to reality that inflation is going to be way above 2% indefinitely, then the dollar is going to fall through the floor, and then things like gold and silver will go through the roof. Remember, in 1971, the U.S. defaulted on its obligations because Nixon took us off the gold standard. But prior to that, if you owned a Federal Reserve note and you were a foreign central bank, you owned an obligation of the United States government to pay you gold. Federal Reserve notes were notes for gold, and the U.S. government defaulted on those notes. We told all of our international creditors, we promised to pay you gold. If you had $35, we promised you an ounce of gold. And they did a couple of devaluations first, but that wasn't enough. And then Nixon said, you know what? We're going to default completely. We're going to give you no note gold for your notes. We're going to pay nothing. So that was an official default. And then gold went from $35 an ounce up to $850. So people who had U.S. Federal Reserve notes, thought they were going to get a certain amount of gold. They ended up getting a fraction of that gold because the value of the dollar imploded relative to gold because we defaulted on that promise. But we didn't officially default on treasuries, but we defaulted on the fact that those treasuries were supposed to be repaid in gold. Because when we repaid treasuries in Federal Reserve notes, that was the equivalent of gold. They used to say the dollar is as good as gold because it was not only backed by gold, but redeemable on demand for gold. So that was the first default. This default is going to be different because obviously we're no longer on a gold standard. So nobody who owns U.S. treasuries or U.S. dollars has any expectation that they're going to be given gold. But they do believe they're going to be able to afford to buy gold. They're going to wake up to the reality that gold's going to be so expensive in terms of dollars, they're not going to be able to afford to buy any. Because I think the dollar is going to implode And I think it's going to lose its status as the reserve currency. And that is going to be a game changer for the U.S. economy because we rely on the ability to exchange the paper we print, U.S. Federal Reserve notes, dollars, for the goods the rest of the world produces. So we are dependent on the rest of the world for the goods that we consume. We don't have to produce goods in exchange. And that's been the free ride that we've had on this global gravy train. And that's going to come to an end. And that's going to have profound implications for the U.S. economy.